say good afternoon to everybody and good morning to those participating in the United States as well. I'm John Defterios, and welcome to the IMF Regional Roundtable, the Regional Economic Outlook that we're going to be reviewing today. It's a pleasure to have everybody. We understand we have some 500 participants signed up. Dealing with what is a dual challenge today in the Middle East, North Africa, and going to Central Asia. Of course, the COVID-19 virus hitting demand for oil, undermining growth, but most importantly, the health crisis that is created for individuals and for governments managing this transition. We have a fantastic panel to welcome, and I will introduce them now. From the International Monetary Fund will be Dr. Jihad Azur, who's the Director of the Middle East, North Africa and Central Asia Department for the IMF. Dr. Nasser Saidi is the founder and president of Nasser Saidi and Associates, and the former chief economist for the Dubai International Financial Center Authority. Dr. Carol Knockley is the chief executive officer and founder of Crystal Energy and a leading consultant based normally in London, who's joining us from Abu Dhabi via the web stream. And Salman Jafari, who's the chief development officer of the Dubai International Financial Center. Give a warm welcome to all of you. Before we get started, I just want to lay out a couple of very clear parameters in terms of how we'll interact, because normally we do this live at the DIFC face-to-face, which is also streamed out, but then we have the additional challenge that we're doing this via WebEx. So if there's any glitches in the process, clearly you'll understand why. It's our first attempt at doing so, but we've been making sure that the internet facilities and that the technical background is all there and operating for us. We will be taking questions in the last 30 minutes of the session. It'll be a 90-minute session. We'll be hearing from Dr. Azur to begin with, and a 12 to 15-minute review of his presentation of the regional energy outlook. Those questions will be fed to us, but I would ask you to put an assignment to that question, i.e. which panelist you would like to address it, and I will manage the follow-ups with each individual members of the roundtable at the same time. Again, this will be going for 90 minutes, 15 minutes on the introduction. The rest will be Q&A that I will lead and facilitate, and the last half hour will be for your questions from the field, which we greatly appreciate. First, I want to thank the invitation once again from Dr. Azur for me to chair the roundtable. I'll hand it over for him, which he'll present with a presentation as well as he does the narration for the first 15 minutes. Jihad, it's all yours.
Thank you, John. And I would like also to welcome everyone, the panelists, the participants, and I would like to thank our partners, the DIFC, with whom we do this twice a year regional economic outlook. It's for the first time we do it virtually. Many things are changing and we have to adapt to that. Let me now start by sharing with you my screen, which will show the presentation that I will go through for the first 15 minutes. And then after that, it's back to John, who will lead the discussion on this spring 2020 outlook. It's definitely a crisis like no other. And this is a crisis that has affected the world, and particularly has affected our region, the Middle East, North Africa, that we are discussing today. It's a crisis like no other. It's a dual shock that reinforced each other and that had several impact on countries of the region. I think we need to start by understanding the nature of the shock, because this will give us clearer view about the outlook and the challenges ahead of us. It's a shock that took place over 4 different waves. Wave 1 was the outbreak of the pandemic that manifested itself in the region in terms of disruption in trade that has affected several sectors, and also especially those sectors who are job-rich, service-based sectors. Before the first wave came into a form of shock to the region, especially because more than 40% of the trade of many countries of the region is with Asia. And the question here is how fast trade will recover, and what does it mean in terms of regaining output for countries of the region. The second episode came with gradual decline in demand. And this gradual decline in demand was because of the slowdown in economic activity, the measures that were introduced in order to address the coronavirus shock, which is gradual shutdown. More than 60% of the oil consumption is on transportation, different form of transportation. Therefore, decline in demand that brought with it the price, and the non-ability of the OPEC Plus agreement to be extended in March, in fact, led to a severe drop in oil prices. We have reached levels of oil prices that were not seen over the last 2 decades. In real terms, we've seen prices that were not seen since 1973 for a region that oil constitutes an important part of its economy, directly for the oil importers and indirectly for the oil importers. This is a huge shock. But it was not the only one. The third one was the impact of the shock that also affected the international financial situation. This region is becoming, or became over the last few years, as we demonstrated in a study that we published recently, one of the most active issuer into the international capital markets among the EM category. And therefore, the shock that affected the international financial markets also affected the region. We saw a decline in stock markets, and we saw a reversal in capital flows with exit of flows from many countries in the region. And we saw also widening of the spread of most of the issuers, public or private sector, from the region. Therefore, drop in trade, drop in oil price, and then also difficulty to access the market. Last but not the least, in order to combat the coronavirus, many countries have to resort to shutting down the economy. And the question now that we are seeing countries starting the deconfinement is how fast and how the growth and the activity in the economy will recover. Therefore, as we see, shock that took place into 4 steps, we're still in a high level of uncertainty. And therefore, the question now to understand the outlook of this year is how countries have reacted. This is one of the most severe crises that the region has to live through over a century. And it came in a very precipitated way, and also it unfolded very quickly. And the question is how countries reacted. The good news here is that authorities responded rapidly to address the coronavirus and into trying to achieve 2 main objectives: protect lives and protect livelihoods. And to protect lives, the key policies were containment measures through restricting travels, through prohibiting mass gatherings, and also scaling up the healthcare system. And the healthcare system, as we will see later, is an important piece of any public management today. The second objective was to protect livelihoods by protecting private sector and citizens. And several measures were introduced on the fiscal and on the monetary side in order to address and mitigate the shock. Also, another objective or another key measure was to keep the financial market functioning. How this took place? Healthcare, and here we see that we had a differentiation in terms of response that is in fact translating the difference in level of preparedness and the current level of spending in the region. Countries who are affected by conflict or hosting refugees are the ones who are facing, in fact, a double whammy shock, because the outbreak of the coronavirus is hitting them and their capacity to react is slow or low because of the weak infrastructure. The second key measure was on the fiscal side, and on average, countries of the region dedicated more than 2.7% of GDP for fiscal, which is equivalent to what EM's countries did. For the developed countries, for the advanced economies, it reached between 3 to 4% on average in terms of fiscal stimulus. More than $64 billion were introduced in terms of measures, both on the revenue side and on the expenditure side. I'll be happy to give more details to you through the discussion today. The second level of action was on the financial side. Central bank reacted very quickly using mainly two tools. One is adjusting interest rates, and we saw a cut in interest rate that reached more than 300 basis points for some countries like Egypt, but also we saw injections of liquidity. And on average, 3.4% of GDP, more than $47 billion of liquidity injection was activated by countries of the region in the first few weeks after the crisis. Therefore, fiscal and monetary were the two main tools that were introduced, equivalent to what other countries have done. And this leads us to see how many countries will perform this year. It will not be a surprise here to say that they will not perform well. The majority of the countries will see a decline in growth that will exceed 4% in 1 year. And this is especially the case for fragile and conflict states. If we look, for example, for the oil exporting countries, last year they had a negative growth of 0.8%. This year they will grow at minus 4.2%, which is a declining growth of 3.4%. Compared to what we were expecting, it will be almost a decline by 6.4%. It's big adjustment for their economy. The same happened to the oil importers, where growth from 3.5% last year will be in a negative 0.7% this year. And compared to what we were expecting, it will be a drop in growth by more than 5%. The situation is more difficult for fragile states because their economy has no buffers, and also because of the geopolitical tension that is still affecting them. This is having a big toll on their growth. If we dive into additional macro economic indicators, we see that the two areas that were most hit were external and fiscal position. And this is mainly for the oil importers, where this year we will expect a drop in the current account balance, and the region will have to finance a deficit in the current account that will exceed 6% of GDP at a period where capital markets are not open to everybody in the same way. The same thing happened to their fiscal balance. And then for this year, the fiscal deficit will exceed 10% of GDP. One could say it's not unusual. What we are seeing currently in other parts of the world is similar. But for countries who have limited buffers, where the level of debt is high, this is an additional challenge. And this is also an additional challenge for oil exporting countries, who will this year will see a decline in their export of something that will exceed $220 billion cumulative drop in their export receipts. In addition to that, their fiscal situation also will deteriorate, and for some countries, like for example Iraq, will deteriorate very fast. Last but not the least, the region, as I said earlier, is becoming more and more integrated into the global financial market, receiving capital inflows, especially in terms of portfolio flows, and both for oil exporters as well as also oil importers, exporters in red, importers in blue. We see that the drop or the markets will be negatively affected. The equity prices will drop, and they have dropped, I would say, in line with what we saw in the EMs, but where, in fact, the impact was bigger is in terms of spreads. And this is something that we have witnessed last year in our analysis on capital flows, that the VIX in the region is double compared to other EMs. Therefore, they react faster to any shock. And here we start seeing a kind of a decoupling between countries who are high-rated and countries who are low-rated. Very recently, we saw Qatar, Saudi, and Abu Dhabi coming back to the market with a good turnout. Saudis issued $7 billion, and the book exceeded $40 billion. Therefore, we start seeing some decoupling, and this is an issue that needs to be addressed. And this is one of the dimensions that I will touch on when I will discuss about the policy priorities. Capital flows were also affected. Countries saw some outflows. No country has resorted to any measure in order to stop that, but we saw some pressure on the capital flows, which is in line with what we saw with the EMs. As you know, more than $100 billion left EMs in few weeks. And this is something also that is new in this crisis. In the 2008 crisis, it took more than or several years for EMs to be hardly hit by the crisis. In this one, it took only a few weeks for the EMs to be directly affected, and the EMs of the region were also among those who were directly affected. Let me now move to the vulnerabilities and the risks, and I will go very quickly on that. The first one is on the healthcare side. The fact that we have a diversity in terms of health expenditures and the quality of health security, and this differentiation makes also a differentiation in how economies are going to perform. Gradually, with the confinement, the pressure will be on the healthcare system, and therefore countries with the strong healthcare will have the ability, in fact, to recover faster and will have the ability to open up faster. And this is now becoming an important, not only humanitarian variable, but also an economic variable. The second important issue is this protracted recession could have a lasting welfare loss on people as well as also on some sectors. And the reason why is because many sectors who are job rich are very important in our economies. Tourism, for example, in many countries like UAE, Bahrain, Qatar, Lebanon, Jordan, Morocco. And this is those are important sectors that provide capital flows and also a lot of jobs, especially for the low-skilled labor. The same also for remittances. On average, more than 6% of GDP of remittances is received by many oil importing countries. And with the drop in oil price and the recession, this could have lasting effect on them. And this is also something that needs to be taken into consideration in the design of the policy measures. The other issue that is going to be important this year is what needs to be financed. And what needs to be financed both for private as well as also for public sector. And here, the amount of funding that need to be financed for private sector exceeds by far what needs to be financed for the public sector. And the risk here is the risk of crowding out. And this is an issue that we need to address when we go to the policy issues. Also, countries who have high level of debt, they have a limited capacity to use the fiscal tool. If they use it beyond the limits, they could risk the whole macroeconomic stability, especially for countries who have adopted the fixed exchange rate regime. Therefore, the high level of debt is a limitation factor for many countries in the region. Now, let me move to my last sections. What are the policy priorities? What we think are the important measures to be introduced this year for countries of the region to address and mitigate the shock of the COVID-19 crisis. And here we think that countries need to mobilize into 3 phases or 3 steps that are interrelated. One, and this is the utmost priority, is protect life and protect the safety of citizens. And this would require to prioritize spending on health to save lives wherever it takes. For countries who have buffers and those who don't, they need to put this as priority. For those who have buffers, they can use it. For those who don't, they need to reprioritize. And within their current envelope, they need to put expenditures on health as well as also on social protection as the priority. The second important pillar is to protect the engines of the economy. This is a crisis that has had a multiple ripple effect, and we need to activate both fiscal and monetary policy for that. Countries have started, they need to do it smartly and wisely. Smartly in a way of making sure that those measures are targeted and timely, arriving on time, and using the technology and other innovations in order to provide the maximum impact. But also they need to be temporary. Any permanent measure, especially for countries who cannot afford it, will create the pressure on their macroeconomic stability. The same thing also applies for financial sector. Improve access to finance. It's a priority for SMEs. Not allowing the liquidity crisis to become a solvency crisis, which in certain sectors could be the case. And this is also another important issue, is to avoid the dislocation of sectors, especially sectors who are important pillars in the non-oil part of the economy in the oil countries, but also for countries who rely on those sectors for job creations to make sure that those sectors are protected. And for that, technology today is a new frontier for many of those countries, using all electronic tool, electronic payment, improving the quality of the financial infrastructure and beefing it up. This is an important priority. Last but not the least, we need to think from now the recovery. Although we don't know when the recovery will come and what will be the shape of the recovery, we're still projecting that it's a recovery with a V shape that will start globally around the fourth quarter of this year. But the level of uncertainty today does not allow us to be firm about that. And therefore, we need to be ready for several scenarios. And we need to be on that also ready to manage a crisis that will take more time to end. And then it will take the global economy several iterations of deconfinement in order to reach a level where we can have a global economy that is back again on track. And this is an important issue. And for that, we at the fund, we are very much engaged. But also countries need to avoid some policy pitfalls. And there are certain important challenges. The first one, they need to scale up health spending still, especially where infrastructure is weak. And this is an important issue for the years to come. Any public finance management needs to cater in the future with a big portion for healthcare and social spending. Reaching out to vulnerables, especially in countries where we have high level of informality, where we have a large proportion of SMEs and especially small companies who their livelihood depends on the economic activity and who they have very little buffers. Ensuring that sustainability, especially with the sharp increase in deficit, at the time where the growth is going to be low, at least for this year. Strengthening the monetary policy in face of large capital outflows, especially for EMs of the region who have been now more and more dependent on the international capital markets for their financing. Last but not the least, strengthening regional and multilateral cooperations, because domestic responses could have spillover across the border. By avoiding, for example, trade restriction, which we are seeing today in some parts of the world on food or on medicine, providing access to healthcare services for migrant workers, and also support fragile and conflict-affected countries, because this disease is spreading among neighboring countries, but also it's very important to reach a level of stability. And I think we have an opportunity today in the region is to reactivate the regional cooperation at the GCC level, for example, or at broader level, at the Arab level, and try to find initiatives whereby we can reactivate several programs that could allow a better support for countries who need to have additional support, temporary support, but also to broaden the level of cooperation to create a market that could cater for big actors in the region. My last slide is to briefly summarize how the fund is helping currently. We are using a 4-pillar framework by responding rapidly in terms of providing access to finance. We're playing here the role of the firefighter. The fund has mobilized it very quickly, more than $100 billion as an emergency facility. And for that, more than 100 countries have already applied. And 30 countries have already benefited from that. This is a rapid facility that provides countries with the possibility to access financing equivalent to 100% of their quota that can be mobilized very quickly. Several countries in the region have already applied, benefited from it, or are in the process. But we are also activated other type of facilities. We provided grants for countries who cannot have access to financing. And in our region, this is what Yemen, for example, got. In addition to that, we extended, or we are revisiting some of our facilities to provide certain number of responses to additional issues, like addressing the liquidity issue for EMs, or addressing the financing for low-income countries. And for that, we have, and we are still revisiting some of our fund facilities, and we are asking our members to provide us with additional means for that. As you know, the fund has $1 trillion of capacity that we are putting forward in order to help our countries. For the region, we have already provided financial support for Morocco in form of drawing on their precautionary line, $3.2 billion. Tunisia gets $750 million as an RFI. Jordan got a new program of $1.3 billion, and we're currently discussing with them maybe to top it up with a rapid facility. And also we gave grants to Yemen, and yesterday the Egyptian authorities have announced that they would like to have access to our rapid facility as a way to strengthen the successful stabilization and recovery that they have achieved with the previous programs. This is on the financing side. On the policy side, we have, in fact, developed certain number of tools, bilateral tools, whereby we provide bespoke policy solution for our member countries. Our teams have geared their support to be the trusted advisors for many countries. We are sharing also what countries are doing, and this is something that is available on our website in order to allow peer-to-peer support. And also we're disseminating some technical support for countries, for their central banks, for their Ministry of Finance. Last but not the least, we believe this is a global response that is needed today for this global crisis. It's a crisis that no other one, and the response has to be equivalent to that. And we have scaled up our coordination with other IFIs in the region, with the World Bank, with EBRD, with other institutions, but also with the regional institutions. Yesterday, we had a meeting among the governors of Central Bank of the Arab world, organized by the Arab Monetary Fund, our partner, and it was an opportunity to discuss with central bank governors what are the priorities for them. Last week, our managing director and our senior management had a meeting with the ministers and governors of the MENA countries, and it was an opportunity also to discuss what are the priorities now and also what are the priorities for the future. Last but not the least, we're trying to mobilize additional assistance that will allow countries of our region to mitigate and also to be ready for the recovery. With that, I would like to thank the audience, and thank you, John, and back to you. Thank you.
And from this point forward, we're going to do question and answer. We appreciate the feed of questions that have been coming in. I would ask the future questions to be assigned again, as I suggested at the top, to a specific panelist, but I can see what we have so far. It's fine, and I can allocate. This is a very quick question for Jihad, and then I want to bring in the other panelists, and I would ask for brevity here. Has the IMF ever seen this much demand, particularly from the emerging markets? I'm told it's nearly 100 countries that approached the fund already. This doesn't seem like the global financial crisis of 2008 to 2010 or recessions we've seen for the last 25 years. Would you make a comparison to what we saw in the Great Depression, the demand the fund is getting in this kind of modern era, if you will, Jihad?
Well, John, since the creation of the fund, this is the highest rate of demand for fund facilities in terms of number of countries. We are breaking records here. You know, we broke records in terms of the global response. The trillions of dollars of the 2008 were exceeded by far in few weeks. And also for us at the fund, we broke records in terms of number of countries. More than 100 countries have requested fund facilities. And also we broke records in terms of our response. In less than 3 weeks, the first country, who is a country of my department, Kyrgyz Republic, got the first rapid facility. This is unusual. And now in less than 2 or 3 weeks max, we are able to mobilize funding for countries if everything is ready. Therefore, yes, we broke the records here, and we expect that the demand will grow, especially in the EM arena. And here, I think we need to differentiate between large EMs who their needs are at this stage more in terms of liquidity financing, especially as we see the decoupling that I mentioned among EMs with high rating and low rating. That is also the case for the global EM category. We will see more of that. We are seeing also countries with whom we have programs and then they needed additional topping up in order to address the shock. This is, for example, the case of Pakistan, to whom we gave a rapid facility of $1.3 billion as bridge between the previous program, the EFF, that is still holding, and then as soon as we finish with this crisis, is to go back to what the reform agenda was for them. Therefore, yes, this is unusual for us, and we expect it to remain as such. And this is why we are calling on the membership in order to provide us with additional support. And also, we are calling on membership, and they have responded positively through the G20 initiatives under the chairmanship of Saudi to provide additional bilateral support to countries. This is an exceptional moment, and I think the response is and need to be like.
Okay, I'm going to ask a brief response from you, Jihad, on this one, though. You talked about the G20 here and the chairmanship of Saudi Arabia. Most of those funds, as you well know, and it's been a record amount of $7 trillion, has been dedicated primarily to the domestic economies and liquidity to the banking system. When are we going to see a much more global approach from the G20 in a crisis of this level?
G20 countries have already, during the spring meetings, provided a commitment to help countries address on bilateral their debt issues, in addition to the support. Of course, the world of the EMs may need more, especially that we are still in one of the most uncertain moments because we still don't know how successful the deconfinement is going to be, how the economy is going to react. We expect trade to recover, but we don't know how fast trade will recover. And are some sectors that are important for trade, airline, transportation, will be impaired, and to which extent they will be able to recover and recover fast. Are we going to see bottlenecks that could lead to inflation in the future, which is not what we expect? But there are many uncertainties today that require to be vigilant. Also, on the financial side, we are not at the mercy of additional pressures in the markets. And how these pressures will be withstand and what will be the impact on some of the EMs is also an issue to be looked at very carefully. Do we have blind spots? Do we have some EMs or others who may be brewing maybe a country-specific crisis that could spill over? I think this is where it's very important at this stage to be very vigilant and to make sure that to have a response that addresses the immediate impact of the shock, priority to saving life, priority to the livelihood, have a coordinated approach to address it, and not to resort to inward-looking policies, try to reinvent what I would call the postmodern globalization. The world economy will emerge differently. We need to think that we are still in uncharted territory. What will be the shape and the form of this global economy? In the last 10 years, we were in a global economy that was driven by technology, by openness, by innovation, and by EMs. What the next 10 years will be, and this is something that will be decided now.
We focused with Nasser on the point that was brought up by Jihad. We're kind of counting almost, Nasser, on a V-shaped recovery, and then people talk about this U-shaped recovery. And I'm not trying to be cliche here, but because of the boomerang effect of the virus itself, where we could be hit in a period of time when we thought we were going to see a recovery in the fourth quarter, you could actually have a double where you go down, you come up, and go back down again before coming up. Is that your biggest concern at this stage, that because of this phased boomerang that I'm talking about for the virus, it could prolong the pain here of a very deep recession?
John, I think that's a very good question. Remember that COVID is a global health crisis, and it has these three components that Jihad was pointing to, in that you've got both the COVID health crisis, you've got for the region the oil shock, and you've got a financial shock. So it's becoming a perfect storm for us. Now, the question as we move forward is what sort of a recovery, if there's going to be one, how quickly will it happen? If you look at the assumptions underlying the report, it looks like a V-shaped, but most likely you're not going to have an immediate recovery in the second half of 2020 for many reasons. First, you don't have any synchronized policy response at the global level. Look at the differences even within Europe, let alone differences between Europe and the United States and the Asian countries. Second, the potential for a recovery itself is going to have to wait for contagion effects from COVID. The wave of COVID is still extending itself into Latin America, into Africa, and other countries, and this could reverberate back into Europe and the United States. So one of the major points, I think, important for the Middle East is to think, if you're going to have a recovery in Asia, will that help you? Well, that is unlikely, even though China and Asia are the main importers of the oil from the region, which is our own main export, if not the only export. China itself and the other Asian countries will only be able to recover if export markets develop for them. But those export markets are mainly in Europe and the United States. And their demand for oil is a derived demand from their demand for exports. So that is unlikely to help us. And therefore, I think the potential recovery is more like the Arabic letter B, yeah? It goes down fairly sharply. It will stay flat for a long time before you will get a recovery. So I'm not seeing a recovery until well into 2021 for the countries of the region. So what you're really talking about is not a recession. What you're talking about for the countries of the region is actually a depression. And we need to be careful because two issues arise. One is the issue of health security, and how do you address health security? What are you going to do about public health in a region where health preparedness, if you look at the Global Health Security Index, we're way below even emerging markets, let alone developed countries. And the issue with health security is that it does not necessarily address many people in the rural regions, in the rural areas outside the cities. So health will have a differential impact across countries in the region. The second point is economic security. We are in a region that doesn't have social safety nets, that doesn't have unemployment insurance, and in which, and this is important, many people work in the informal sector. The estimates are that 30 to 35% of activity actually takes place in the informal sector. So if you look at monetary policy, fiscal policy, and other policies introduced by governments, they don't necessarily reach the people in the informal sector, and particularly labor. So if you look at a country like Egypt, it's estimated that something like 75% of new entrants into the labor market are in the informal sector. So how do you help those? And how do you help the SMEs? SMEs account for over 90% of businesses and certainly more than 50 to 60% of the employment. But yet they only get 7% of the funding. So even though central banks have introduced facilities, lowered interest rates, provided financing, that financing does not necessarily get to them because the banks, particularly over this period, will prefer to lend to governments. That's much less risk. And what Jihad was pointing to, and that's an important issue, is there may be some crowding out. Governments, public sector is taking more and more of those resources. So one important point, I think, is that this is depression economics. And unfortunately, the countries of the region don't have the automatic stabilizers. They don't have the fiscal tools. And what we may be heading towards is a vast increase in inequality, a vast increase in poverty, and I think, a lot of social unrest and a lot of political unrest. So this could be the beginning of a second Arab Spring, or Arab firestorm, as I prefer to call it. I think this is what is on the agenda. And what I think it calls for, and Jihad was pointing to it, is much more cooperation. We don't have that cooperation. So I very much welcome the IMF's Rapid Financial Initiative, and I hope more countries will benefit from that. But I think we should also invite the countries of the region and the institutions of the regions, the multilaterals, to participate in that. What I mean by that is the Arab Monetary Fund, the Islamic Development Bank, the African Development Bank, all should join this effort, particularly to reach out to the poorer countries. If you look at the slides we just saw, it is shocking when you think about those countries that are fragile states that have a large number of refugees, but also displaced. The health policies have not addressed people in the camps, let alone the displaced people. And that is a big issue moving forward. We need to talk about how we're going to address those. And therefore, this issue of social unrest should be very much on the agenda. And one final item I think we need to talk about. It is this matter of food security moving forward. What we've seen as a result of this global crisis is a big disruption in supply chains. It's not only international supply chains, but also domestic supply chains.
Okay, so I'm going to leave it there. That was a fantastic analysis, and I appreciate you following up on Jihad's comments there. But we're going 5-6 minutes an answer. I've got 10 questions that have been sent in. So I'm going to ask the panelists here. From here, there are 90 seconds to 2 minutes, please. Very laser-like in our analysis, please. Thank you. Very, very good context, and I appreciate all of that. Carol, kind of the giant elephant in the room here is the oil price. And as Dr. Saeedi was speaking, I was looking at the quote. We're down 16.5% on WTI and roughly another 4% on Brent. So we're looking at $14 and $20 and change. Because of the demand scenario we see today, which is down about 30%, and the uncertainty, talking about the W, or the analogy that Dr. Saeedi used in the Arabic letter, when does demand return to normal for oil? Could we see demand drops in the fourth quarter still at 15% because of the global shock we're seeing today?
Hello, John. Well, I'll be able to tell you when oil demand is going to recover, when Jihad can tell me exactly when the global economic growth is going to recover. I know we have a wide range of scenarios and forecasts and a huge uncertainty, and this is actually creating a similar level of uncertainty in global oil demand. And just to give you an idea of the really wide range of uncertainties that we have in the forecast, if you look at the forecast between international organizations and the banking sector, I mean, it ranges, the demand destruction for oil ranges from anything between 4.3 million barrels a day to 9.3 million barrels a day. So we're talking really about 5 million barrels a day, which is really staggering in the history of the oil industry. So it's a very big range of uncertainties and scenarios. And today, perhaps everywhere around the world, it is the economy that is driving oil demand and as a result, oil price. But in this region, in the Middle East and North Africa, it is the oil price that's driving the economy because of lack of diversification. So of course, we'll be watching quite closely when demand will recover, but I will not be able to give you the answer unless I have greater certainty about when will the lockdown be lifted and how will the economies recover after that, because that will dictate the future of oil demand.
Okay, Carol, a quick follow-up then on that. I'm looking at the figures from the IMF of a negative 4.2% for the oil exporters overall in the MENA region this year, and a snapback to 4.7%. Knowing the dependency on crude for their revenues, doesn't that seem a little bit too generous, a swing here of nearly 8 to 9% in the span of a year?
Well, this is the V-shaped recovery that both Jihad and Dr. Nasser were talking about. And again, it can be anything. It can be a V-shaped recovery. It can be a U-shaped recovery. So I personally think it's a bit too optimistic. Because of the region's dependence on oil revenues and oil prices. And I don't see oil prices, I don't like to make forecasts about where oil prices are heading, because as we saw over the last few weeks, this goes beyond anybody's expectations. But I fear that the region is going to remain hostage to lower oil prices for a longer period. And this rapid recovery, for me, came a little bit as a surprise. But I'm not only looking at the short term, John. I would like to refer to a publication by the IMF earlier this year in January, which is about the fiscal sustainability of the GCC country. And one figure caught my attention, even though then the IMF was using an oil price scenario of $55 a barrel, real terms. They said, and I quote, that under this oil price scenario, the net financial wealth accumulated in the GCC region could be wiped out by 2034. And if oil prices go down to $20, that could bring back to maybe 2027 or around that period. So the issue is not just what will happen in the recovery by next year. It's a much more longer term problem, structural problem that the region has to address.
Okay, thanks very much, Carol. It was superb again in terms of the analysis. I'm going to bring in Salman Jaffrey of the Dubai International Financial Center here, and specifically define the role of the private sector with this sort of outlook. In a lockdown scenario, and I'm here in Abu Dhabi, it hasn't been nearly as severe as Dubai. Salman, what is the role of the private sector as it tries to read the tea leaves here? You go from a 24-hour lockdown into a scenario where we're opening up malls, beginning to open up food and beverage. How do you strike the balance here to restore confidence of the private sector in dialogue with the governments, but also of the consumer, which gets a little bit confused by signals that we're seeing, not just in the UAE, of course, in the Middle East and North Africa? Please, Salman.
Thanks, John, for the question. It's very good to be here on this panel today. Look, there's no doubt that the structural questions on economic growth, fiscal monetary policy are given for the region. The DIFC is a very interesting example of success where you have public and private coming together. So we have a top-down structure whereby we've provided a framework and an ecosystem for business to thrive, and that experiment has worked really well for 15 plus years in traditional financial services. And so the kind of secret sauce there has been to continue to promote private enterprise by enabling it through ongoing and improving regulatory and legal upgrades, as it were. So in this situation, okay, there is no doubt that strong fiscal and monetary policy support is going to be needed, but we've done a couple of things. Much like other governments, we in our capacity have initiated a number of stimulus packages or packages to assist private enterprise in the DIFC, ranging from corporates to our retailers to companies. And so that is a necessary condition to allow companies going through a tough time these days to at least steady the boat. Okay. Number two, we have a particular bias probably towards what we're seeing a lot of is a transition period where our private sector has taken a very aggressive turn from traditional and conventional finance into the innovation and digital space. Now, what we've seen essentially is, a good example given by both Dr. Saidi and Jihad was on the issue of funds flows and remittances. In the last 6 to 8 weeks, we've seen a tremendous uptick in interest in new businesses and new business models from the private sector seeking to find ways to transmit money from here into the emerging markets corridors. And so the timing of that has been very interesting because our regulator has just recently announced new regulations. So to answer your question, that issue, the process of innovating to accommodate private enterprise continues. The support is there in place, both from a regulatory perspective as well as a stimulus perspective.
Okay, very good. Thanks, Salman. I have a series of questions that I want to start addressing, but I would like to have Jihad address this question that was posed by Mr. Masher, who was a former World Bank official, but also former Minister and Deputy Prime Minister of Jordan. We saw enormous pressure on governments in the region: Iraq, Lebanon, Sudan, Algeria. The list is a very long one, Jihad. Do you worry, because of the economic pressure we're seeing from the COVID virus right now, that what we saw in 2019 can actually be accelerated in 2020? Is that your biggest concern from the IMF standpoint, that there was a realistic reason for protesting before, but this takes it to a whole new level? And how do the governments avoid that, Jihad?
Thank you, John. It's an important question that you're raising, and this is something that we have highlighted in the past, and then we are still worried about. Here we are in the region where the level of vulnerability is higher than on the average because of certain number of factors. One is the number of refugees that is the highest in the world, and the internally displaced. Countries who have been inflicted by conflicts have very weak infrastructure. Also, countries who have very weak institutions also have difficult capacity to react. Therefore, yes, of course, it's very important to be aware that the level of vulnerabilities are higher, and we have highlighted that in previous reports where we introduced this social unrest index that has shown that starting 2017, we saw an increase again of social pressure similar to the one we saw in 2011. Having said that, I think it's very important to look at things differently from the past. One is, even for those countries, the priority has to be on the healthcare side. Protecting lives is the priority everywhere. And this is where I think, and this is where we are at the fund very much focused on, is how to bring the attention of the international world community to help those countries. We recently did a debt relief for Somalia, who for decades was faced with the conflict and the impact of the conflict. We're trying to do the same for Sudan now. Iraq is a country also that has been inflicted by conflict. Therefore, yes, it's a category that we need to be very vigilant on addressing their issues, but also there are other categories or other issues to address. The region entered this crisis with certain level of vulnerabilities, high level of unemployment, especially at the youth level. Average level of unemployment exceeds 12% in the region, and for the youth it exceeds 30%. This is an issue that we were working on through inclusive growth agenda, and also by trying to put this as priority. Second issue is, in addition to that, is the issue of high level of indebtedness, especially for the oil importing countries with limited buffers. Now is the time when you need to use your fiscal instruments in order to provide protection, and also in order to provide support to your economy. And this is for those countries where the issues are. Okay, with that, I think there are solutions still. And
I ask you to wrap up in 30 seconds, please. Thanks.
No, I'm saying there are solutions, and the solutions are to reprioritize and to increase the level of regional coordination. Therefore, we should not let this crisis go wasted and not use it as an opportunity to address some of the structural issues that the region has been facing for decades. It's the time to address some of the issues that have prevented the region from growing and growing fast. Regional barriers, lack of coordination, lack of utilization of the means that the region has in order to be invested in the future of the region. Fast embracing of the digital world, removing some of the barriers. All these issues are now more important than ever. And I think with this crisis, we have the opportunity, because business as usual is not working anymore. And therefore, we need to have an unusual solutions. And this is where you need to break all these barriers. And I'll stop here.
Okay, good, thank you. Nasser, it's a question that came up, and I'd love to have Carol jump in off the back of yours. And that is a question that's come in saying that the IMF is talking about emphasizing spending on healthcare and building infrastructure, which it has been doing with the oil revenues. But in a case where there's an over-dependency on oil right now, how realistic are we being to say you kind of need to tackle it on your own with the help of the IMF or the World Bank, but take care of your healthcare systems? Is that realistic, Dr. Saidi?
Well, I think it has to be realistic. Let's put it this way. This is a threat. If you don't take care of your health sector, you're not going to be able to adjust your economic sector and be able to get recovery moving again. So what we need to think of is what sort of new tools. For example, we mentioned regional cooperation. One way to do so on the monetary side is to start having some central bank swaps with the central banks of the region, because we're highly dollar-based and the economies of the region are all pegged to the US dollar. So that would be one way. The other one is to start using money markets and establishing public debt markets and corporate debt markets more efficiently. We haven't had the development of local currency markets. This is the time at which you want to do so. The third item, which should be on the agenda, is the role of the sovereign wealth funds. The sovereign wealth funds traditionally have invested outside the region. I think they should reorient their strategy towards the domestic economy in terms of private equity, even PPP, helping bring foreign technology and know-how into the region. And one final item I think needs to be on our agenda, which we have not mentioned, is particularly in the GCC countries, is the role of expatriates. They are an important part of the labor market and the human capital, but yet none of the measures that we've seen taken in many of the countries of the region address the needs of those expatriates. What you don't want to see happen is those expatriates leaving the region. So you need to think about greater integration of expatriates into the labor market through social security systems, review immigration systems, and things like that. So this is the time for really looking at structural changes in terms of policies and looking forward and saying, yes, I'm going to have to borrow more. The capacity to borrow is there, maybe not for vulnerable countries like Bahrain and Oman who are going to face issues, but this is the time where you might need a solidarity fund, particularly at the level of all the Arab countries. And this is a role I think the IMF can help in putting together.
Terrific. Okay. Carol, I'm going to alter my follow-up to Dr. Aidi's comments here. We have this budget gap here. We have the lowest cost producers in the region, particularly in the Gulf states, but their break-even price hovers anywhere from 65, in the extreme case of Algeria, to over $150 a barrel. Isn't this the ultimate time where we have to be realistic with closing the spending when you have revenues within a $20 range for oil? When's that reality going to set into some of these governments in the Gulf in particular and beyond?
Indeed, John. I mean, I heard this advice that this is a time for to implement economic reforms, and it actually is true. Whenever there's a crisis, prices collapse, governments start to look into how to reform their economies and introduce drastic changes to reduce the vulnerability that they currently have. However, experience shows that unfortunately, as soon as prices recover, many of these reforms are delayed and many also evaporate. I hope today it's not going to be the same for one main reason, that, I mean, Jihad previously said that we have to look at things differently from the past. And actually, John, what we are seeing today with the demand destruction is actually giving us a flavor, a bit like an aperitif, of how peak oil demand is going to look like when it really happens. So when we say that the region definitely has an advantage because it is a low-cost producer, but it doesn't really act as a low-cost producer. For a low-cost producer to be an advantage, they should be able to sustain low prices for a long period of time. But this is not going to happen in the region under the existing economic structure and policies. I mean, they don't really have anti-cyclical fiscal policy. On the contrary, we see how government spending, look at Iraq, for instance, just trails oil price, and with it, the economy is exposed fully to the vagaries of international oil markets. I know that some countries here, they have sovereign wealth fund, which makes them better shielded, but even then, it's not quite a robust economy that is not exposed to changes in oil prices. Some might say that they have managed to diversify a little bit away from oil, but even then the non-oil sector moves in tandem with oil prices, which tells me that's not quite real diversification. And the fiscal break-even chart, I know we cannot really read too much into it, but gives us an idea about the scale of the challenge that this region is facing. And it doesn't really build on its major advantage of being a low-cost producer, which will be an important problem when peak oil demand becomes more notable in the coming decades.
Okay, Jihad, I'd love to get your comments, and I'm going to circle back to Salman. We've had some very ambitious spending programs in the diversification to the 2030 plan in Saudi Arabia with His Royal Highness Mohammed bin Salman, NEOM, the Red Sea Island resorts, diversification with Qadiyah as a major project for the entertainment sector. In reality, with $20 oil and what Dr. Nakli was just talking about a prolonged downturn in demand, should these things be revisited then in the kingdom, knowing the strain the budget is under there?
Thank you, John. I think, one, we need to recognize that certain number of steps in terms of diversifying the economy and the fiscal outside the oil have been taken after 2015 crisis. Several countries have introduced value-added tax, excises, certain number of other fiscal measures. They have moved into a medium-term fiscal framework. Those are steps in the right directions. Countries like UAE, Saudi, Bahrain introduced that. Others, I think, now they need to accelerate this move that will allow them to be less pro-cyclical. Therefore, those steps that are going in the right direction need to be accelerated. Of course, the model of diversification was service-based, globally integrated in the value chain. And I think it's very important to understand how the global economy will get out of the crisis. Is it U or V or different form of shape? I think we need to accept that we are in a highly uncertain moment, and this uncertainty will stay with us. I agree with Mohsen Khan, my friend and predecessor, who made a comment also this morning saying, we don't know. Yes, we don't know how the recovery will take place. And therefore, I think it's very important to be ready for all kinds of scenarios. And where the scenarios that are safer are. One is to create in the economy levers for growth that are based on strong labor, strong access to finance, and therefore the enablers of the economy are well preserved. Two is to find new area for growth, and the regional potential is higher. Sovereign wealth funds can play a role, regional institution can play a role, and the private sector too. There is one category that we did not discuss since the beginning, is how the private sector can adjust and then can be nimble in addressing this issue. The relationship socially, how we integrate those who are in the informality. Technology today can allow us to fast track the integration of the informal, and also will allow the social program to be more impactful, especially those who are in the margins or in the rural area or in the informality. Therefore, I think, yes, we are facing one of the biggest challenge that the region has faced over a century. And this is a time not to waste the time. And this is what we are, at our side of the fund, trying to do, is bring immediate support in order to stabilize, raise the important issues for the countries of the region in order to focus on and build a coalition internationally and regionally with the regional institution and the key countries in order to have a solution that will allow the whole country to benefit from. What we saw in the past, whenever you leave one country aside or behind, this is where you create the problems of the future. And this is something that we need to address going forward.
Okay, thank you very much. Salman, I did promise I'd circle back to you, and the question that came in on the chat here, how to balance the notion of protecting the banking system, which is very important, and we've seen governments respond in doing so in liquidity, vis-a-vis encouraging lending to the small and medium-sized enterprises. So what are your thoughts about trying to allow your SMEs to survive in this sort of a very disruptive environment today, Salman? You need to unmute your microphone, Salman.
No, it's unmuted. Can you hear me?
Yes, I can now. Thank you.
Great, thank you. So two quick responses. One is going back to the earlier conversation on private versus government. You know, the issue of structural reform for the region is a challenging and daunting one. But what I can say about the private sector is, you know, even before COVID, even before the collapse of oil, you know, there has been an annual structural gap in infrastructure investment in emerging markets. And we are in the center of 46 hours of that market. So I'm hoping that, you know, with healthcare, people forget healthcare is one big piece of infrastructure. There are massive opportunities to channel a couple of $1 trillion of excess private capital slushing around in this region into those endeavors. And government can be an enabler, but it's not a necessary condition every time. So there's a particularly interesting role to be able to work with governments or public entities to be able to channel private capital into infrastructure. This is a pre-COVID issue, and I'm hoping that COVID accelerates the need to push capital into key areas such as healthcare and education. To the point of SME, I don't want to give the impression that, you know, digital solves everything, but an important thing has happened in this crisis. You know, I've been here 12 years, and technology and digital has been used synonymously and erroneously as something that supports business, that you plug it in and make it go faster. And I think if there's one thing that's really come out in this crisis is just how critical the digitization of all economy, of every part of the economic sector where feasible is. Financial services is obviously one that is near and dear to us, so we have a pretty good view on that. The SME picture is in some respects very complex and very straightforward. The complexity is obviously in the structural impediments that banks have from a risk perspective. We have seen so many scores of startups, financial technology companies coming up with ideas on how to funnel capital into the hands of those who need it, working with banks and in the financial system. So I'm pretty bullish about that. That's got to be part of the problem, part of the solution.
Okay, very good. I have a number of questions on Lebanon, so I appreciate the audience again with very active participation. One of those is a question for Dr. Jihad. Jihad, I need a 30-second question because I want an analysis from Nasser on this. Has the Lebanese government and the Egyptian government both asked for IMF assistance at this stage of the cycle?
The Egyptian government announced yesterday that they have requested a rapid fund facility as well as also an SBA. And this is something that we were discussing with the authorities for some time now. Objective is to help Egypt address the issue of the coronavirus, especially its impact on some of the key sectors, tourism, trade, as well as also export sector, and also to protect what has been achieved over the last programs in terms of increasing the buffers, creating additional growth, and also maintain the macroeconomic stability. Lebanon, we have active dialogue with them. They have inquired about the fund rapid facility, but they did not yet request any financial support from the fund.
They still have not. That's
No.
quite surprising. Carol, you had your hand up. Go ahead.
That's for me.
I wanted to add.
To Nasser.
Yeah, I wanted to add something, another whammy that hit Lebanon. So first we have the double whammy of the self-inflicted domestic crisis. On top of that, you add the global crisis that we've been discussing. But yesterday, actually, we started receiving some news about the results of the exploration activity that Total and its partners were carrying out in offshore Lebanon. And as we speak, I think the Ministry of Energy and Water is disclosing the results of the exploration activity. But so far, they they are not indicating anything positive. And for me, the way I see Lebanon when it comes to the reforms, I have the feeling that reforms were delayed because some officials and the government as a whole has put too much weight and hope on making gigantic oil and gas discoveries offshore the Lebanese water. But unfortunately, they seem to have fell into the trap of the resource curse, but without the resource.
Yeah, there's a question now for Nasser that says that Dr. Saidi in his presentation to the Harvard Alumni Club in Lebanon talked about a recovery plan of 3 to 5 years. Do you think this is realistic, Dr. Saidi? And then I'll come back to Jihad in terms of are they being sensible and trying to dig themselves out of this dead hole that they're in? Dr. Saidi first.
Well, what you need is a comprehensive plan. It means a macro, fiscal, financial, banking, currency plan, which includes public debt restructuring the banking system, including the central bank. All of that put together will require multilateral funding. That means going to the IMF in order to get what I estimate to be a 25 billion to 30 billion package. That is what Lebanon requires. And a program that would be extended over 3 to 5 years. I think, although these are very dark days in terms of Lebanon, that is still feasible. But what it requires is really for government to admit that they need this program, accelerate and open up negotiations as quickly as possible with the fund in order to get going. That hasn't happened yet. It needs to happen. That's an urgent priority.
Thank you, Dr. Saidi. I know, Jihad, this is a sensitive issue with you because of your cultural background, the same thing with Dr. Saidi, and your position, most importantly, with the International Monetary Fund. What are the wise next steps? I've got 5 questions here about where Lebanon goes next. What's the recommendation from the fund?
John, the fund has been in contact with the Lebanese authorities on a regular basis. And when the Lebanese authorities have requested the fund technical assistance recently, the fund is providing it. Government has shared with us their draft, the plan that they are currently working on, and the team has extensive discussions with the team who has prepared the plan. Of course, I concur with what Nasser is saying. Lebanon at this stage need to have a comprehensive reform agenda that brings confidence back, and confidence of citizens, confidence of investors, that has not only one pillar, but has all of the pillars, financial, fiscal, economic, and structural reform, and last but not the least, to have a strong social package. I think what Lebanon currently needs, with all these shocks that came and the backdrop of very low growth, is a strong weakening of the social fabric, especially with the numbers that we're seeing in terms of increased number of vulnerabilities. And I think this is also an issue that needs to be put part of the reform package. We keep the dialogue with the authorities, and Lebanon is an important member with whom we have historically a strong relationship, and we will keep it.
Thank you very much. I'm sorry, I'm getting a little bit of feedback when I jump back in, so I apologize to our audience listening here. 2 questions again, and I'll try to synthesize them now. It's for Dr. Nakli, and I'm going to bring in Salman Jafri. Could you please talk about climate change preparedness in the region? And you said not losing opportunities, Jihad was saying, during this crisis. Does this low oil price, though, make it difficult to justify spending, Carol, in the renewable space? Or can the renewable space, solar in particular, wind in some examples like Morocco, stand on their own 2 feet at this stage? People have been enjoying the satellite images of a reduced footprint of the greenhouse gases and obviously the smog in different cities. What sort of leverage should the Middle East and North Africa, stretching to Central Asia, take at this stage on diversification of their energy supplies?
Yes, John, I mean, the current crisis may have brought one silver lining, that is the impact on climate in terms, because we're traveling less, we're driving less. However, when it comes to investment in renewable energy, I fear they are going to be hit, just like any other sectors in the economy, particularly because they still require government backing, whether directly or indirectly, and in this region, perhaps more than any other region, because of the limited presence of the private sector. So if you look back at the financial crisis in 2008, for instance, we saw that one of the first victims in the energy sector was investment related to renewable energy and green projects such as carbon capture and storage, where many projects were simply cancelled or deferred indefinitely. And we are likely to see the same situation today. However, I mean, it's absolutely right that this region needs to do something about not just diversifying its economy, but if you look at its primary energy mix, it is perhaps one of the least diversified regions in the world, because it largely, if not solely, depends on oil and gas, unlike other countries and regions where you have other sources such as coal, renewable energy, nuclear energy. However, I think that what the real opportunity, immediate opportunity today from lower oil prices is not really increasing investment in renewable. I think that will be like a struggle, but actually maintaining the reform agenda when it comes to removing subsidies. I know some countries in the region have already tackled that, but they can still go further. And that would be an opportunity, because when oil prices are low, then it is easier to remove the subsidies. So this is really the silver lining I see in the short to mid-term, and not really an increase in investment in renewable energy.
Okay, in Dubai, Salman, there's been quite active investment into the solar sector, as you well know, and it's very cost competitive. We've seen the same thing in Saudi Arabia. Is this push going to continue despite the fall in oil prices? What's a realistic viewpoint from the UAE perspective, would you suggest?
So I think what we've seen is a pretty consistent upturn in commitment and interest to all things sustainable, whether you use SDG or ESG, the acronyms of your choice. That has been very interesting to UAE, of course, at a policy level, and the DIFC as well from an Islamic finance perspective. A couple of examples of that come to mind, in addition to just significant interest from our clients. Dr. Saidi will obviously be familiar with this, but we have Haukama, which is leading entity in corporate governance that's had an ESG index for 10 years. We recently also, the DIFC and DFM signed, actually launched the region's first bottoms-up sustainable finance working group, which I think is the right way to shape the conversation in the region on things that will impact the environment and sustainable development. Other examples, we signed this deal with the Dubai Islamic Economic Development Center, as well as with the Climate Bonds Initiative, which is another way to kind of respect the fact that standards are important in the space. So the answer to the question is, one of the benefits, obviously, is having a cleaner skyline, but I think that boat has left the port. I think the commitment that the region has to green, sustainable finance and the environment is there to stay, for sure.
Nasser, please jump in.
Just a quick one. I agree with Carol that the incentives to go into renewables at this stage will not be there because of these low oil prices. However, producing energy today, electricity today, through solar and wind in our region is actually much cheaper than using fossil fuels, diesel, and all the rest. So this is an opportunity really to get rid of the shale oil industry, because this is the whole purpose of the oil price, is to kill the shale oil industry. The way you do that is to free up oil resources for export to the rest of the world, produce more with solar locally, and that means you also have more revenues staying behind. And I fully agree with Carol, this is the time to get rid of the subsidies, because you've got low oil prices. Get rid of the subsidies, create the fiscal space that you need, and then move forward on a Green New Deal. I think this would be an opportunity really to pour massive resources into the private sector, into clean technology, clean energy. We know from the 2008-2009 crisis that when you give stimuli, as happened just after that, it tended to go to the polluting industries, heavy manufacturing industry, cars, transport, and all the rest. But maybe this time around, we can be forward-looking, long-term thinking and say, we need to change our energy mix. This is the time to do it. And doing more oil is not going to create the jobs that we need. What you need to think of is how do you support where the jobs are? That is retail, hospitality, get out to households, think about logistics and all the rest, and e-commerce. Digitalization helps because you can go to households through digitization, but it won't create the jobs that you need. So what you need is loan guarantees, supporting the SME sector. You need to provide wage support. We haven't seen any of the countries in the region providing wage support as you've heard, say, in the United States or Europe. This is where you need that economic security package to be put in place.
Great. Thanks, Nasser, for that. Carol, a sensitive question, but I'd love to get an answer on it. Was that price war by Russia and Saudi Arabia foolish, in a sense that prices were already derailing because of the drop in demand? Or, as Dr. Saidi is suggesting, there was a clear motivation here, and that is to drive shale out of the market, and it's doing so rather aggressively. Which side is correct here?
Yeah, it's an interesting angle to address because, first of all, yes, I know everybody was describing what happened in early March when Russia refused to join in OPEC in terms of implementing production cuts after the organization met in Vienna and said that we should do something more to support prices. Everybody rushed to say it was a price war. But it was unclear, price war by who against who, the Saudis against the Russians, the Saudis and the Russians against the US. But even if it was a price war, for me, it was too short-lived to acquire this kind of labeling, because one usually expects price wars to last a little bit longer and leads to a race to the bottom. But let's look a little bit, definitely you said if it's foolish, for me, it's not really foolish. It's probably, it was badly timed because just few weeks, if not few days after that price war started, the numbers started to come in and highlighted the severity of the economic crisis caused by COVID-19 pandemic. But one question about shale, I feel that the story of shale is becoming a little bit like the OPEC story. Every now and then people predict its demise. And since the arrival of the shale revolution in the US, especially from 2010 onwards, people kept on talking about the end of the shale revolution in the US, and each time shale comes back stronger. And yes, it is the first oil to leave the market because of its nature. It's flexible, it responds fast to oil price, unlike conventional oil, but it tends to be the first to return to the market as soon as prices recover. Yes, we're seeing some bankruptcies among the fragile investors, the small investors, but mind you, the structure of the industry has changed over the last few years, and we saw the big companies entering the industry. So whatever the intention was, if you told me that it's just to kill shale, I think then they had to, and then it would be foolish in this case. But I think one of the other victims of what we are seeing today is not necessarily shale, is other high-cost producing oil fields somewhere in remote locations, including in Canada, Russia, Brazil. So these ones, they are killed, they are difficult to bring back on stream, but it's not, but I don't see it's the end of shale at the moment.
Okay. I'm going to wrap it up here in 5 minutes, and I wanted to get 2 key questions that were fed again, and I can go for another 15, so I appreciate all the feedback from those that are watching. It's fantastic in terms of the flow. Jihad, I'm going to give you the last word, but Salman, I wanted to ask you a question. In the mindset of the DIFC, and what we've seen here, for example, I've been doing my broadcasting from the apartment in Abu Dhabi on a terrace, and you could say you could work a 16-hour day because you're in and out and on call. Is it going to profoundly change COVID-19 the way we work in this region or not? Do you think it's going to be lasting, or people are going to say, we experimented with it, we didn't learn a whole lot, we go back to business as usual?
My sense is it's probably going to reflect the economic charts that my esteemed economist colleagues are accustomed to, which is up and down, but moving forward upwards, right? So I think it's clear to me that a certain threshold for engagement with stakeholders, whether they're investors or clients or customers, a certain hesitation has been broached for sure, which is the sense that, oh, you can't engage with someone on a substantive matter of economic interest unless you're face to face. So I think that mindset will be different. However, this region does have cultural and social norms that make it very unique and different, which is why people come here, particularly to places like the DIFC, which is that you build relationships, you get to meet people, you learn to develop trust. People are accustomed to doing that face to face, but that does not mean that you cannot operate effectively as an investment manager, as a client person, as a salesperson, and employ digital. So net, I think the workplace has changed, and I think you will see significant evolution within our working environment of how we provide flexibility to an increasingly very young and mobile workforce.
Okay, thank you for that. Again, we have different strands of questions. We could go on for another 30 minutes. One of the questions we have, and I'll let the team from the IMF send an email out or put it on the site. This is being recorded, but there's a lot of requests for people to be able to review it again. So I'm just going to put that publicly, and then we could consider that because it's being streamed out at this stage. So there's a demand to see it yet again. Jihad, on the last word here, I wanted to see if you can combine two thoughts. This is going to be a major blow to tourism and travel in the region. There's no question about that. We see the strains on Emirates and Etihad already, Qatar Airways. How long will it take for that sector, which was building for so long in such a positive way, to recover? And what is the silver lining, was the final question I got here on the question stream. What's the silver lining out of a crisis and pandemic of this nature, in your view? And then I'll conclude at the end. Jihad, please.
Thank you, John. For me, the silver lining so far is how countries have been able to react and to contain the crisis. Countries who have different levels of readiness were able to activate very quickly a certain number of policies to address the expansion and to contain the crisis itself. And this is a good step that one can build on. The other good step is we saw a high level of adaptability in various countries in order to cope and also in order to address this challenge. We are in a moment that doesn't have equivalent in the past, and therefore we should rise up to this challenge. Are sectors going to regain the model that they used to have in the past? No. What is the next one? I think it's very difficult. It's being charted now. We are writing history now, and we are designing what the economy is going to be in the future now. And this is where I think it's very important for the region to learn from the mistakes of the past, and also to learn from the capacity that has been able to deploy very recently. Learn from the mistakes of the past is being passive. In 2008, the region thought that it was not affected by the crisis, and then discovered that, yes, it was affected by the crisis. Therefore, I think what is important is to assess really the extent of the shock and try to think about the second and third round of impact. And this is something that we need to keep in mind. There will be a second round impact. There will be certain issues that we don't see now, because in the middle of managing the emergency, we don't see. And those issues need to be addressed now. We need to be very wise on how we use fiscal tool and monetary tool. And also, we need to make sure that while we are doing this, we are thinking of the recovery in the future. Therefore, where are we today? We are at a point where we finished with I would say, the first round of reaction to the crisis. We are in a moment where things are still could go in any direction. And therefore, what has been needed in the past in terms of reforms should stay with us. And maybe it's an opportunity to accelerate it. This is the first opportunity I see. The second opportunity I see that there are certain number of taboo that lived with us for some time, that economies, for example, the oil exporting economies have to be pro-cyclical. It's something that we could break, that the barriers that exist between countries cannot be removed, that the region cannot build strong regional institutions, that instruments cannot be redirected. The sovereign wealth funds cannot be redirected to help the economy grow. And that also, that the only social protection system comes with the family and the group. And there is no social contract that can provide with all that. And that last but not the least, and borrow this from Marwan Mashar, who put it on the screen, that everything has to be centralized. I think this is new opportunity to include, and inclusion is not only by providing support to people, but also by bringing them in the decision making. My last point is, when we were doing our projections, we had to change it on weekly basis. And it was very difficult because things are unfolding. And I think maybe Carol said it. Our projections are based on April 7th numbers. And since things have changed, therefore, we need to keep updating ourselves. And therefore, we need to be nimble, and we will come back maybe at a faster track than we usually do, not on semi-annual basis, to give an update on how things are and where things are heading to. We at the fund, we want to respond, and we want to respond fast. And we cannot respond alone. We need to respond with others. And this is something that we are doing. And also, we need to respond to what the region aspires to. And this is something that, what we have heard today from you, from the other panelists, also from the audience in terms of questions, are very useful for us, because this is how we can improve the way we can help and respond to the needs of the region.
I'm going to ask a follow-up question, if I may, Jihad, to close. And this is something I've personally been covering as an emerging markets editor. But there's a perception in this crisis, unlike the global financial crisis, that people are cocooning. There's a populist fervor worldwide. And if they have the assets, they deploy them domestically. And that the COVID crisis hasn't sunk into Africa, Latin America, Southeast Asia in a profound way. Is this a mistake not to have a collective approach as opposed to a nationalist approach in the response to such a pandemic of this level? And I would ask you for a minute answer and reply because we're over, but I think it's a very important question if you don't mind taking it on.
Well, of course, this is my short answer. Yes, indeed, this is a moment where we should be coming together. And if there is a moment where the solutions cannot be done on a country by country basis, even for the largest economies, it's now. We need also to recognize that over the last decade, growth in the world was driven by EMs. We need to recognize today that productivity has improved tremendously. We need to recognize that risks like this pandemic cannot be controlled in one country. And therefore, if we want to be able to have a stable recovery, we need to make sure that we take care of each other. Therefore, it's definitely today more than ever. Working together is the must. Working differently, yes. Addressing maybe some of the deficiencies in the past, of course, but I don't see any other way at a regional level or at a global level not working together. And also at an institutional level, the state cannot be alone in this game. The state has to be with the civil society. The civil society cannot do it alone. And we saw with this crisis how important the state is and how there is a need to invest in strong state, not in a fat state. Therefore, all the players or the stakeholders are needed, and they are needed now. And this is where I think it's definitely one of the key messages. No one should be left alone, and nobody should work alone.
Thank you very much for that. Salman Jafri of the DIFC, Dr. Nasser Saidi of Saidi & Associates, and formerly of the DIFC as the chief economist and a respected voice in the region. Dr. Naqvi, it's great to have you on the analysis of oil and gas because it's so important to the region right now, particularly with the price pressures we see as we speak. And Dr. Jihad Azur, the director for the Middle East, North Africa, and Central Asia. Thank you for the invitation again. That was an experiment, right? Going WebEx for 90 minutes, but I have to say everybody played by the rules. And I specifically want to thank the audience. Fantastic feedback on the questions. And thanks for the compliments for all the panelists and the participation We've had 4 of those at the very end. Thank you again, and I hope it's going to be posted on the IMF website for people to recall again for research work as well. Thank you again for your participation.